Right now, while most investors are still watching gold headlines, a group of buyers with far deeper pockets is quietly moving into silver. Sovereign wealth funds. Together, they manage over $12 trillion in capital, and even a tiny shift in their allocation can move an entire market. This is not retail money chasing a chart. This is patient, multi-decade capital that almost never makes a mistake about timing. And right now, that capital is circling silver. If you have been waiting for a sign that this rally still has room to run, this might be it. But here's what almost nobody is talking about. While the headlines obsess over central banks stacking gold, the real story brewing underneath the surface is a physical silver market that is running dangerously thin. In this video, we are going to break down exactly why sovereign wealth funds are positioning into silver right now, what the data on COMEX and global inventories is really telling us, and what this could mean for silver prices heading deeper into 2026. Stay with me, because by the end of this, you will understand why some analysts believe we are watching the early stage of a structural repricing that most of the public has not even noticed yet. Let's start with the official sector. For decades, the unwritten rule among central banks and sovereign funds was simple: buy gold, ignore silver. Gold was the prestige asset, the symbol of monetary power. Silver was treated as the poor relative, just an industrial metal. That rule is now breaking down. Central banks bought more than 800 tons of official gold every year since 2022, and that buying accelerated again in the first quarter of this year, with Poland and Uzbekistan leading the charge. But something new is happening alongside that gold accumulation. Sovereign wealth funds, the same entities that quietly built multi-trillion-dollar gold positions over the last 2 years, are now extending that same defensive logic to silver. This changes everything for silver investors. Why? Because these funds do not chase momentum. They do not panic buy, and they do not panic sell. When a fund with a mandate spanning decades decides to build a position, it accumulates slowly, smoothing purchases over months so it does not spook the market. That kind of demand is not a short-term spike. It is structural. It sits underneath the price like a floor that keeps getting higher. Now pay close attention, because this is where the story gets serious. While institutional money has been building positions quietly, the physical silver market has been breaking in ways most people do not fully understand. Silver hit a nominal all-time high above $121 in January. It then corrected sharply as the Federal Reserve held rates steady, the dollar strengthened, and leveraged traders were forced to unwind positions. But underneath that price volatility, the physical foundation of the market kept deteriorating. COMEX registered silver inventories, the metal actually available for delivery, fell below 100 million ounces earlier this year. By spring, coverage ratios had dropped to roughly 13%. That means for every ounce sitting in deliverable COMEX vaults, there are more than 7 ounces of paper exposure layered on top of it. In January alone, COMEX warehouses saw over 33 million ounces withdrawn in a single week. That is more than a quarter of the entire deliverable pool disappearing in 7 days. This is exactly why smart money is moving early. Because when the gap between paper promises and physical metal grows this wide, it does not take a massive shift in demand to create real stress in the system. It only takes a modest increase in buyers actually asking for delivery instead of settling in cash. And the Silver Institute is now projecting a 6th consecutive annual supply deficit for 2026, with structural shortfalls draining global above-ground stockpiles for 5 straight years running. Let's talk about why this deficit is not going away anytime soon. Roughly 3/4 of all silver mined globally comes as a byproduct of copper, zinc, and lead mining. It is not mined for its own sake. That means even when silver prices spike, miners cannot simply ramp up production, because the economics of those mines are driven by base metals, not silver. Supply is structurally inelastic, and that is a phrase you should remember because it explains why this market behaves so differently from oil or even gold. On the demand side, the pressure keeps building from every direction. Solar panel manufacturing continues to consume enormous volumes of silver. Electric vehicle production uses hundreds of grams of silver per car for electrical systems and battery components. And now, artificial intelligence infrastructure is adding a new layer of demand, with data centers and high-frequency circuit boards relying on silver's unmatched conductivity. China has compounded the squeeze by reclassifying silver as a strategic material and restricting exports, which has fragmented the global market into separate regional pricing zones. Shanghai premiums over Western benchmarks have at times reached $8 to $10 an ounce, a sign that physical metal is simply not flowing freely between markets anymore. Now, let's bring this back to the macro picture, because this is not happening in isolation. The Federal Reserve has held its policy rate elevated for longer than markets expected, citing persistent inflation risk over labor market weakness. That has kept the dollar firmer than gold and silver bulls would like. Meanwhile, across the Atlantic, the European Central Bank continues to navigate its own balancing act between sluggish growth and inflation that refuses to fully cool. For European savers watching their currency's purchasing power erode year after year, this is precisely the environment that has historically pushed capital toward hard assets. Add in the freezing of foreign reserves we saw imposed on Russia, and you can understand why sovereign wealth funds and central banks alike are treating gold, and increasingly silver, as reserves that sit outside the reach of any single government's jurisdiction. So what happens next? What happens next could shock most investors, and there are three scenarios worth understanding. In the bullish scenario, sovereign wealth fund buying accelerates. COMEX delivery stress intensifies, again heading into a future contract month. And the combination of a persistent supply deficit with institutional demand pushes silver decisively through resistance near $95, opening the door toward triple-digit prices once more. Some banks, including Bank of America, have floated long-term targets well above $100 if these structural forces persist. In the moderate scenario, deficits continue in the range of 95 to 117 million ounces annually. Industrial users gradually find ways to economize on silver usage, and price growth becomes steady rather than explosive, rewarding patient holders without delivering a dramatic spike. In the bearish scenario, a stronger dollar, a delayed Fed rate cutting cycle, and a cooling of geopolitical tensions around the Middle East and Eastern Europe take pressure off safe haven demand, sending silver back toward the $50 to $60 range as leveraged positioning unwinds further. Analysts at UBS have explicitly framed the current tightness as something that could prove temporary if trade tensions ease. The honest answer is that nobody knows with certainty which path plays out first. But here's the part that should change how you think about this. In every one of these scenarios, the structural deficit does not disappear. The byproduct supply problem does not disappear. And the slow, deliberate buying behavior from sovereign wealth funds does not reverse on a headline or a single rate decision. That is the difference between trading silver and understanding silver. Traders react to the next CPI print. Long-term capital positions ahead of a structural shift that takes years to fully play out. So here is the core message to take away from everything we have covered today. The world's largest, most patient pools of capital are beginning to treat silver the way they have treated gold for the last 3 years, as a strategic reserve asset rather than a speculative trade. At the same time, the physical plumbing of the silver market, the actual metal sitting in vaults, has never looked thinner relative to the paper claims stacked on top of it. That combination, deep-pocketed buyers stepping in while the deliverable supply shrinks, is exactly the kind of setup that has preceded major repricing events in this market before. Whether 2026 delivers another sprint toward the highs or a slower grind higher, the direction of travel for the structural story remains the same. If you have been on the fence about precious metals as part of your wealth preservation strategy, this is the moment to do your own research and understand exactly what is unfolding beneath the surface of this market. Because by the time it becomes obvious to everyone, the easiest gains will already be gone. If this breakdown gave you a clearer picture of what is really happening in the silver market, make sure you subscribe and turn on notifications, because we track these shifts in real time before they hit the mainstream headlines. And let me know in the comments, are you positioning in gold or silver right now? Type gold if you are focused there, or type silver if that is where you see the bigger opportunity. I will see you in the next one.